Module Overview. No business plan is complete without sound financial projections and a realistic budget. For farmers and agripreneurs, these financial components serve as both a compass and a control panel. They tell you where your business is headed financially, whether you are on track, and when you need to adjust course. Financial projections and budgeting are the language of investors, the blueprint of growth, and the foundation for sustainability. Whether you are managing a tomato plantation, poultry farm, or fishery business, these tools are crucial for planning, decision-making, securing funding, and surviving market fluctuations. What are financial projections? Financial projections are estimates of a business' future financial performance. They include predicted income, expenses, profit or loss, and cash flow over a specific time, often 1, 3, or 5 years. These projections are forward-looking statements based on assumptions about prices, yields, production costs, market trends, and financing needs. Key components of financial projections: A. Projected income statement, profit and loss statement, shows expected revenues, costs of goods sold, COGS, gross margin, operating expenses, and net profit. Example: revenue from selling 5,000 kilograms of tomatoes at 500 naira per kilogram equals 2.5 million naira. Expenses equals 1.8 million naira to net profit equals to 700,000 naira. Cash flow statement: A. Displays when money enters and exits the business. B. Tracks how you manage income, operating costs, loan payments, capital expenditures, etc. C. Vital in agriculture where cash inflow is seasonal, but expenses may be year-round. Balance sheet projection. A shows the expected value of assets, liabilities, and equity over time. B. Helps determine business solvency and capital needs. Break-even analysis: A. Calculates the point at which revenue equals cost. No profit, no loss. C. Important to know how much you must sell to cover expenses. Sensitivity analysis: A. Tests how changes in prices, yields, or input costs affect profit margins. What is budgeting in agribusiness? A budget is a detailed plan of how a farmer intends to spend money to meet business objectives. While projections show the big picture of expected performance, a budget breaks it down into specific, actionable items, line by line and month by month. Types of budgets. 1. Operational budget. Covers day-to-day farm activities, planting, feeding, weeding, harvesting, etc. 2. Capital budget: A. For big purchases like tractors, irrigation systems, or land clearing. 3. Cash budget: A. Tracks the timing of inflows, e.g. harvest sales, and outflows, e.g. salaries, feed purchase. 4th Enterprise budget: A. Specific to each crop or livestock unit. B. Example: poultry budget, maize budget, fish farming budget. Steps to create financial projections and budgets. 1. Gather data: A. Past financial records, if available. B. Market prices, production capacity, input costs. C. Seasonal trends and risks. 2. Estimate revenue: A. Calculate based on expected production volume times selling price. 3. Estimate costs: A. Divide into fixed, e.g. land rent, salaries, and variable, e.g. feed, seeds, fuel. 4. Project profitability: A. Subtract total costs from revenue. B. Factor in taxes, loan interest, or subsidies. 5. Build monthly or quarterly budgets. A. Allocate how much will be spent and earned per month. 6. Include contingency: A. Set aside 10 to 20% for unexpected expenses like crop failure, pest outbreaks, or equipment breakdowns. 7. Use tools: A. Use spreadsheet software, Excel, Google Sheets, accounting apps, Wave, QuickBooks, or budgeting templates. Importance of financial projections and budgeting for farmers. 1. Informs pricing decisions. Understand what minimum price you need to break even. 2. Helps secure funding. Investors and banks want clear financial outlooks. 3. Aids in managing cash flow. Prevents running out of money mid-season. 4. Improves strategic decisions. Enables cost-benefit analysis of alternatives. 5. Encourages discipline. You can track every naira and kobo spent or earned. 6. Promotes sustainability. With long-term forecasting, you can build resilience. Sample budget table, snail farming to 6 months, see diagram above. Estimated sales. Sale of 5,000 snails at 200 naira each equals 1 million naira. Expected net profit equals to 500,000 naira. Common mistakes to avoid. 1. Ignoring cost fluctuations, e.g. diesel fertilizer feed. 2. Overestimating yields or market prices. 3. Forgetting to account for losses, post-harvest loss, death rates. 4. Not budgeting for equipment maintenance. 5. Using outdated or irrelevant financial data. Learning outcomes for Module 8. By the end of this module, you will be able to 1. Understand the components of financial projections. 2. Develop income statements, cash flow, and break-even analyses. 3. Prepare and manage multiple budget types. 4. Apply budgeting tools and templates. 5. Use financial planning to guide and sustain agribusiness growth.